The week ahead, we're starting off by looking at the daily bar. You see the daily bar, the market has been very, very mechanical. We've come right down to the 200-day moving average. That's where they bought the market yesterday. You see also a downside breakout from the 3+ months of balance. The important fact of this market is, do we get continuation to the downside, or do we have a downside breakout failure? Let's take a look at the profiles. When you look at the profiles, you can see it's the same thing. You've got the two lows down there. The real question is, do we break below those lows, which would be continuation to the downside, or do we have at least a short-term low, and do we rally back up above Friday's high? Things are a little different right now. The jobs report really challenged the market. It was unexpected, and it showed quite a deterioration in the labor market. And that's the deterioration that I think the longer term money's been seeing in the market. This market's been gradually deteriorating, and it didn't really show any, real solid to the downside until we got into the number yesterday. Now, to me, I'm going to leave it like that. Did you have the downside breakout, or do you have a downside breakout failure? It's as simple as that. But what I really want to spend time on today is I want to spend time helping you understand the importance of looking at the market and looking at the structure of the market. So many people are oriented only to price, and they don't understand the importance of structure. First, I want to come up and I want to look at Thursday. Look at Thursday. There's 6,800 level. One time the market sells off at the 6,800 level. J period, the market rallies up within a tick and sells off from the 6,800 level. In K period, the market rallies up and sells off at the 6,800 level. So that's 3 times you got mechanical selling. At that point in time, the odds are that the market is getting extremely short. The market came down and the shorts got caught. The shorts got caught, and you can see how sharply they rallied the market. You have to be able to understand the difference between short covering and new money buying. The importance was the automatic selling by short-term emotional traders at the 6,800 level, this almost exacting level. That is the action of short-term traders, not the action of longer-term, more serious money. Now, I want to show you the same thing again on Friday. So if you take a look on Friday, you got an excess low in the morning. The market got too short on the early morning break. The rally, if you look up here, the rally comes right to the low, Thursday's low. Goes a little bit above it. Notice that the H period low is just, it's changed. It pulled the half back up a little bit. But for all practical purposes, the low came from half back. Then look and see at the I and J period low, how close together they are. That is a sign of very mechanical short-term buyers. The market then rallies up to K period, right almost at almost at the low from Thursday. You get a couple ticks above it in L period, and then you get the very sharp liquidation break. This, it's short-term traders, you have to understand what's going on, and it's hard because you're questioning yourself as they keep doing this period after period after period, and then you get the real liquidation break late in the day. So you had a similar situation on Thursday and a similar situation on Friday. If you don't know how to look at the market and you don't know how to look at the references and understand when they're coming from very mechanical levels. For example, when they buy J period, just a tick or two above I period, that is unlikely to be stronger money. That is more likely to be very short-term traders. When the H period comes from almost half back, short-term traders. And it's hard. It's when you watch this yesterday, I mean, you're watching the price, it's getting later in the day, and you're questioning yourself, are you wrong? And of course, you see what happens on the liquidation break. But if you're looking and say, okay, value is building lower on the day. Okay, these are both of these days, the liquidation on these days was very profitable if you understood. This is, I'm not a big proponent of the, zero dated options, but I can tell you they were very, very profitable on these breaks because you could buy them for almost nothing. And then you get the liquidation break. I mean, you get multiple times on your money. So where are we now? I mean, a couple of things to think about. When markets go down, they very often go down not because the longer term money is selling, but because the longer term money is not buying. Now, once the market gets down, 7, 8, 9%, it's not unusual to get a wave of new money selling, of liquidation. Instead of the longer term money just not buying, the market gets down 7 to 9% or so, and then it's very possible that you get a different dynamic, and that different dynamic is the institutional money that's been long for so many years now starts to panic and starts selling. They don't panic very often, but they do panic the same way we do as short-term traders occasionally. Keep in mind, as the market goes down, they start getting calls from their clients questioning, should we really be holding all of this cash, all of this money, all of these equities? And they get the pressure, and all of a sudden they can panic just like we do as short-term traders. When it happens from the long-term money, it can be very traumatic on the market. Okay, so where are we? Just to wrap this up, we have a downside breakout. The question is, and the low is almost exactly on the 200-day moving average. We have a potential downside breakout. We have potential downside breakout failure. You have a very short distance to have an understanding of what's really going on in the market. Have a great week. Thanks.